Hello, Propenomix people, and good morning to Property and Propenomix people as well who have tuned in. So, for those who have watched before, you might know I like to start these with a quote, and this week's is, by sticking to our deficit reduction plans, we can keep interest rates low. And it is, I think, hard to overstate the fundamental importance of low interest rates for an economy as indebted as ours. By sticking to our deficit reduction plans, we can keep interest rates low. Our plan to fix the broken economy takes each of the three problems head on. First, we have a clear plan to deal with the deficit, and it is fair. The richest 20% are making the greatest contribution to the deficit reduction and paying the most. And that was David Cameron in 2013, who encapsulated the link between fiscal policy, as in the budget, deficit plans, fairness in contributions, and the resulting level of interest rates, or monetary policy. And that quote pertains to not only the deep dive, as it usually does, but also really everything that's going on in the UK at the moment on steroids. If you thought 2013 was bad, David, how about 2025? Now, this week's deep dive is about the Bank of England's activity in the past week and, of course, the accelerating budget speculation that we're dealing with. But as the calendar creeps towards a new year, it's a natural time to have a pause and tackle the biggest challenges that keep small to medium-sized enterprises, property businesses, from achieving true sustainable growth. For most, this boils down to two core areas. They need to lay a bulletproof strategic plan for the next 12 months, and also they need to crack the code on financial measurement and accountability. If you've ever felt lost in a sea of bookkeeping data, or if your productivity methods are falling short, it's time to switch from doing to leading and truly understand how your assets are performing. Book in on our next property business workshop with myself and Rob Turner, Thursday the 22nd of January in central London. There's a link in the show notes, and the link is also at tinyurl.com/PBWNINE. So I'll kick off with Trumpwatch, as I always do. The government is still shut down in the US, and now consumer confidence is the next thing to slip. Trump has the usual appearance of really not caring and hitting the other side where it hurts, initially starting from a position of withholding SNAP payments, which is the Supplemental Nutrition Assistance Program. Most people still call them food stamps, which is what they used to be called. So around 42 million low-income Americans qualify for them. That's 12.5% of America, or 1 in 8. God bless America, right? The shutdown has now surpassed its previous record. Most Americans are, according to polling, blaming the man in charge, which must rank as one of the least surprising conclusions of all. A district court order mandated these payments instead must be made. The situation is still developing, but the Trump administration has gone to the First Circuit Court of Appeals to block the order, and then straight to the Supreme Court when they didn't get the first answer that they wanted. That court order was therefore temporarily frozen. Some states had acted very quickly on the Friday in order to follow the first court's order before it could be frozen or blocked. The administrative stay placed by the Supreme Court only lasts 48 hours. Generally speaking, savage stuff. FIFA also invented a peace prize this week, but I'm sure it's got nothing to do with President Trump. After all, it isn't even what he calls football. Then there have been state and local elections, of course, as the calendar turns 1 year since President Trump's election win. The election of the New York mayor looked a complete formality on Polymarket, and sure enough it was. Markets gave Mamdani a 98% chance of winning that election nearly off. Don wasn't happy, as he holds Mamdani in the same regard that he holds the Mayor of London. The phrase on the left, the Trump slump, referring to a poor economic record in charge. However, growth is good. Unemployment is worsening, but nowhere near as bad as the UK. Inflation is 3%, so it's right at the top of their acceptable scale. And of course, tariffs have done their bit on that front as well to drive inflation forward. And the stock market's hit new highs, although recent events have been blow-offs rather than increases, of course. So that's more of a mixed picture, really. But you would think with those, the average American would be relatively happy. But the truth is, and what the economists are saying, the commentators say in general, is the short-term metrics are okay and there's long-term damage. Tariffs continue to be the subject of an argument. The debt deficit situation is horrific, but then I can't remember a time when it wasn't horrific, to be honest. I think the point is Trump and percent are not really sorting it out or changing it, to be honest. Fear indices and economic uncertainty is a concern going forward. I did see a truth, or whatever they call it, on Truth Social from Donald Trump that have been shared. Those pictures get everywhere, don't they? To be clear, I'm not on Truth Social apart from anything else, but he was saying that every non-high income American would get a $2,000 stimulus check. I think he made a couple of little promises before that might not have perhaps played out as expected, but bribery is the way forward, I guess. It'd be very stimulative if he did go ahead with that, but ultimately this $1 trillion worth of debt that racked up between August and October, the $1 trillion in basically a couple of months is a very, very, very scary number indeed. And markets are not stupid. They're not taking their eye off the ball here. And it's still far too much of a deficit realistically. Fear indices and economic uncertainty are a concern going forward. The trade deficit has also narrowed a little bit. That was at the centre of all the trade negotiations because Trump saw leverage for negotiation. And I think you'd probably have to argue he'd used the leverage fairly well. But of course, there are legal implications that are going to continue to show themselves. But, that's a pretty standard day in the life of the Don, right? What else have we been hearing about? Well, escalation against drug cartels, missile strikes on vessels in the Eastern Pacific and Caribbean. Be careful out there, folks. Trump describes the US as being actively involved in armed conflict with these cartels. This continues his war on fentanyl. As usual, the law is secondary to the decision to launch these strikes, and Congress has tried to get the president to seek explicit congressional authorization. That was defeated in the Senate. The debt's been in the news because of this growth at the fastest rate since 2000. $1 trillion in 71 days it was. Remember, there's no crisis at the moment. There's no emergency. There's no other buzzword that people love to use. Just gigantic federal overspending. And as the Americans would say, the math ain't mathin' for me. So as usual, it always feels a bit safer and warmer when we turn our attention back across the pond. Watkins smashed in a big week 43 as we look at the UK real-time property market. Listings printed 27,500, 1,800 down on the week before. The market continues the listing slowdown towards the end of the year. The average week 43 saw 29,100 homes listed. Don't know if that means the balance is starting to redress a little or continuing to redress maybe. It certainly seems so. I've been referring to that for a while. 2024 at this point was very buoyant and listings were accelerating. Still not been as much research as I'd like to see on that front in terms of where those listings have really come from. I think those in the know all know they've come from the landlord community ultimately, primarily, but we're kind of got our fingers in our ears and not really saying too much about it. Largely speaking, I think we rely on people like Zoopla and Rightmove to produce figures, and they have done, but they've been very, very quiet when they've done that. They haven't produced papers, they haven't talked about fanfare, they haven't talked the damage that a shrinking private rental sector market will do, or perhaps they can't evidence that a shrinking private rental sector will do so much damage because it grew so meteorically between sort of early 2000s and 2012, 2013, and then really leveled off. And I think personally, I think it's shrinking today, but we'll see. We'll see how that goes. When don't say I didn't tell you so. When in 2027, this is suddenly the hot topic of conversation because people can't get rental properties. But there we go. The average week 43 in the calendar sees 29,100 homes listed, as I said. So that's still we're about 1,600 behind that. So yeah, definitely a bit of balance redressing, but it will be a slow process as we come back more to a normal sort of market with maybe 600 to 650,000 homes on the market. We're still well ahead of that at the moment, 70, 80,000 ahead of that at least, if not more, ahead of the top end of that range, I should say, if not more. There'll be another clear out at the end of the year, though, in terms of no hope of stuff on the market, but there'll be the Boxing Day action, so that will sort of tell us again where we're at, and that'll be with us sooner than we would like to think. I've been using this Ready Reckoner for about 6 months now. There's 10% more stock on the market than a typical market. And that's because we had 2 years of overperformance in listing numbers compared to historical averages. And we've only had a couple of months, if that, maybe 6 weeks of us creeping back below those historical averages. And there have been 1.53 million homes listed this year so far, so over 1.5 million homes. And you know that's pretty speculative because in a normal sort of year, or certainly more normal than the last 4 or 5 years we've had in the book, you'd kind of expect about 1.1 to 1.2 million transactions to take place. There have been wobbles, there's extra stamp duty, there's all these things to consider. It's harder and harder to move, or more and more expensive, I should say, not necessarily harder and harder. But we're 9.1% ahead of the 9-year average in listings. That does include 2020, so I'd argue we're more like 10+% ahead, really. But we're really inching back towards those 2024 numbers now, week to week. We were 6 to 7% ahead, and we're only 1.5% ahead now. So we've pulled right back. So it's 7.8% fewer houses listed in week 43 than in week 43 of 2024. Very nearly the same number that we did in week 43 of 2023, but well ahead of the pre-pandemic listings for week 43. So bear that in mind. So we've got to see more. It's still only 1 week. Let's see how we go as time goes on. The average price, interestingly, this did catch my eye, of what was listed last week, or in week 43, the figures run about a week behind, Sunday to Sunday, was under £400,000. So the same week in 2022, bearing in mind that week would have been the week coming up to the beginning of November. So we'd had the mini budget, we'd had a month to kind of take stock, get hit in the face by all of that. And the average listing price in that equivalent week in 2022 was 432,200. And it was 434,400 in 2024. So under 400k, cheapest listing week for 4 years when we look at the week 43 comparables. So what's this all coming from? Well, cheaper stock is selling, but are people also going on at more realistic prices in the first place? Just because high value properties are not going on because of the budget? All these things are inevitably having an impact, right? And we'll just keep a watching brief. We'll keep an eye on it. How many price reductions? 18,300, which is a decent drop from 21,300 the week before. And it's a fair gulf from the big numbers that have been reduced in 2025 in general. But people are hunkering down for Christmas now. September's completed number was back to 14.1% for reductions. We're waiting for October's number. August was anomalous at 11.1. The year average has been 13.2. So more stock, more reductions, not just from an absolute perspective, but from a percentage perspective as well. So I've been using the ready reckoner, 25% more reduced stock out there than a normal market. There's certainly been times when at least 33% more reduced stock than normal has been out there. We have been reducing 100,000 properties a month. We may now have dropped to a run rate where we're reducing about 80,000 properties a month. Still not particularly small when you think about it like that. But this 18,300 was lower than the number of reductions in 2023 and 2024, but it was still higher than 2022, week 43, interestingly enough, even though we'd had the lettuce storm, or whatever you want to call it. How many sold subject to contracts? 23,500. Annual average has been 26,100. Average week 43 prints 23,800. So pretty close to the average, right? Still looks pretty healthy, right? We're plenty past the day of the lettuce as far as 2022 went. And sold subjects are still up 4.2% year on year and 12.5% up on the pre-pandemic market of 2017 to 19. So it's the second best year for 9 years behind 2021 for gross sales, if we look at the year to date so far. But week 43 of 2024 was a more buoyant week. But having said that, that week was a lot better than the equivalent weeks of 23 and 2022. And 2024's week 43 was actually equivalent to 2021's week 43. And that was a very, very hot market indeed. Now, we've still only got the numbers for October in terms of how many homes were on the market at the beginning of October, just over 750,000. We saw the peak at 763,000 at the start of August. As I say, this market needs to come back to sort of 650, 660. At the end of September 2024, we already had 723,000 on the market. So things had already started to accelerate from a listing perspective. There are only 4% more properties on the market on October the 1st than there were on October the 1st, 2024. But that 2024 number was the 8-year high. So we haven't sort of gone into incredibly ridiculous new territory this year. We've just sort of persisted through that. We've had more stock. We've had this glut of stock. And therefore, we've seen lots of reductions and lots of people giving up. And some people, of course, some landlords looking to exit, give the market a try for 6 months. What do? Well, they don't give the property away. So they might auction it. They might go to a property trader, a cash buyer, something like that. They might just rent it again because they can't get the price they thought it was worth. They can't get the price they want for it, and they're sick of paying the council tax and the bills. Very possible. We did have a number, thanks to Chris, though, for October's prices per square foot, and that was £338.38. That was 1% up on September's number, which, as you'll see later on, is fairly congruent with what the Halifax was saying about October's market as a rule, although it caught the economists by surprise as a general rule, as it usually does. There had been a 3-month downward trend in pricing on sales per square foot agreed. We were in August, we're back to where we were in August now. September's number was 336.5, August was 338.78, but August was down July's number, and June's number was particularly good, £346.45. So I still think we're going to see 1.5 to 2% for 2025 when those figures hit the land reg. Is the ONS that I usually like to go by. Halifax and Nationwide are not a million miles out of that region anyway, so not very hard to predict given that we're nearly at the end of the year. Although you'd be surprised how many economic forecasters still can't predict anything with any accuracy, even when we're in November for 2025. So the September slide, back of August, it wasn't great, but that 1% coming back. June to September saw a drop of 2.9%. And I think if a lot of people, not just Charlie Lambdin, but a few others had seen that those numbers, read Chris's stuff carefully, they'd have generated a lot of content, a lot of fear-mongering content on the back of that. But October has sorted it. So, quick maths lesson. Just because there's this big correlation, and there is a big correlation, 92% or so, Chris tells us, correlation between the sold subject to contract prices and the land reg prices 5 months hence. Right, so very, very strong correlation. But just because the sold subjects went up 1% in October doesn't mean 1% will be the number for October at the land reg, right? Correlation, not quantum, is what I'm saying to you here. The quantum may well be a shade lower. Then it also has to do with how the ONS measure that difference month to month, right? The type of property that's selling other than anything else. As I said, at the moment, listings-wise, I would speculate that a lot of expensive places are not going on until after the budget, which will end up being Boxing Day or something like that, probably. So let's see what happens to the average price of stock that's offered over the next few months. I don't think it's indicative of the start of the price collapse that the Charlie Lambdins of the world spend far too much time talking about. Fall through smack on the long-term average of 24.2%. Very little volatility for weeks and weeks and weeks. Net sales at 18,200, 3.6% up on last year to date, 9.5% ahead of the pre-pandemic market, and absolutely smashed ahead of the 2022 levels now. More than 30,000 net sales in front of 2022 now, as we've had that crater that appeared, that asteroid that hit the planet in terms of that mini budget at the end of September, and the havoc it wreaked on the property market in the immediate aftermath until Ms. Truss was deposed and replaced with Mr. Sunak. Now, I always give Chris Watkin this weekly shout out because he's much more prolific than only this epic tome that I always try and share. He releases every week on the UK property market. He comes up with brilliant stats on a regular basis. Drop him a like, a subscribe, a comment, and while you're doing that, if you haven't liked this video yet or subscribed to it or both, I'd really appreciate it if you did so. If you're in the industry and you want support being a more effective communicator, being more in touch with your local market, that's Chris's core business ultimately. Do you want to be able to grow your business through the means of communication and showing your authority and your expertise? That's what Chris does. He publishes his article on the Property Industry Eye website, and the video weekly always goes on his YouTube channel. He always has a guest. It's lots of fun. At Christopher Watkin, check him out. Okay, what about this week's macro? Do we have a macro nap as the economy continued to lumber towards the budget? We had the final PMIs for all sectors, Halifax House Price Index. There was also a rare bit of room this week to look at the economic activity and social change in the UK report from the ONS. And then last up, the Gilts and Swaps, of course. Okay, the PMIs, anyone who's listened to this before knows that I love them because it's real-time insight on the private sector side of the economy. Not bad. Indeed, very strongly historically correlated to economic performance. Not so good at predicting it when you have a government policy weakened private sector and a strong public sector, as we've basically had in the past nearly 18 months or so. But they're still worth pressing on with. So, manufacturing first, we had a final print of 49.7. The flash a couple of weeks back that I reported was 49.6. So pretty much where it was. but rising production in general, domestic weakness, international weakness, but output up for the first time in a year, slower rates of contraction. Pretty positive stuff for a print that's very close to that baseline level of 50, although it's still just under. What did the S&P Director of Global Market Intelligence say? Well, he said the bounce might be short-lived, and there are real concerns about that. JLR restarted production in October following that cyber attack, so he argues that's a false bounce, and you can understand that. Sluggish demand, growth came from eating into order backlogs, it says. Whatever happens in the budget, though, further increases in the minimum wage are coming. The current mid-range before they settle on the new minimum wage is £12.71 now at this point, which is a straightforward 50p or 4.1% increase. I strongly suspect this rise, currently below the market rise, which is closer to 5%, is more likely to be higher. The range they're working on at the moment is £12.55 to £12.86, so £12.81 looks more likely to me. The market that predicted wage increases down to 3.75% to 4% by the end of the year looks a bit hopeful at this point, although that may well be the case in the private sector. The public sector is 1% or more ahead of that at the moment. So I think more like 4.5% to 5% is more likely for minimum wage. And businesses know this, they're expecting it, and they're accordingly pretty bearish about it. Business optimism is an 8-month high, but it's still below its long-term average. So Rob Dobson closes his report by saying that the businesses are waiting until domestic and geopolitical backdrops exhibit greater clarity. The only thing I'd say, Rob, is it might be a long old wait, my friend. So what about construction? Well, a horror headline on the construction PMI report, I'm afraid. Construction activity declines at fastest pace for over 5 years. I've written extensively about this of late, not least 3 weeks ago, when I analysed that Molior report that caused all the fuss, and a whole slew of other pieces of evidence and research. The substrap lines are equally mortal, speaking of steep reductions in housing and civils activity, staffing levels falling to the greatest extent since August 2020, and one small piece of cheer, input cost inflation moderating to a 12-month low. So what was the print? 44.1, down from 46.2 for September. That's 10 months in a row below the 50 handle. The civils printed 35.4, which is ugly. The resi 43.6, which is still pretty ugly. So sub 45 is problematic territory. And commercial printed 46.3, which helped the index. A similar figure to the September commercial property print. What did the economics director at S&P, Tim Moore, have to say? He said it was another challenging month. Well, no kidding, Tim. Why such reductions in workload? Risk aversion, delays in decision making. I wonder why. Oh yes, the budget, of course. But the suggestion has been one of heightened political and economic uncertainty. On the bright side, there are more subcontractors available. Of course, that none of them have got any work. Supply performance also had a month of sustaining improvement, but the fear is for the future. Fragile investment sentiment, weak sales pipelines, overall optimism levels, the highest since July, as the prevailing sentiment is expecting lower borrowing costs, boosting demand projections. What about services in the composite index then? Much more pleasing. Solid upturn in new work lifts service sector output in October. Business activity and new order growth accelerating. Employment close to stabilisation, and input price inflation at an 11-month low. Very positive chat in all the PMI reports for the Bank of England and MPC. Even better, it was once again a report where the flash number, 51.1, actually ended up printing 52.3. At least twice as positive if you look at the difference between 50 and 51.1 and 50 and 52.3. It's more than twice as good, that number. So the composite printed 52.2. Its flash was 51.1 as well. Now, the official happy status is sort of 53 plus, because that represents a sort of nicely growing private sector economy. But we've moved out of these mini doldrums we had from Q3. It's services that drive the whole economy. There's no doubt about that. Doesn't mean construction and manufacturing aren't important, but 80% these days is services. So hugely important part of the growth figures, apart from anything else. You've got to see this as good news, right? Despite some of the best efforts of this current government policy to favour the public sector and to ultimately disadvantage the private sector and expect them to pick up the bill. Yes, I still stand sour at them for what they did in 2024 because they have ultimately set fire to about 300,000 jobs apart from anything else, although some of that is being put down sensibly so to the advent of AI. And then this is where it gets very difficult. How much is AI? How much is simply making it 10 or 11% more expensive to employ people? Well, You don't do something like that without it being a genuine economic shock. And that's what the employers' NI rise was in 2024. Make no bones about it. So once more, those final PMIs exceeded the flash numbers when there'd been a tick upwards. If we print in the 52 handle for November, that'd be a great result. It is possible. Very little reference to budget concerns actually in the reports this month, little tiny bits, but business has worked out as it does. The people being hit this time around in the budget are the people. Everyone is going to take it with whatever tax threshold squeezing and subbing national insurance for income, tax jiggery pokery that's about to go on, so that working people aren't going to pay more tax if you accept an extremely convoluted set of circumstances. You know, I'm 6'8" as long as I'm on stilts. That's the equivalent, in my opinion. Anyway, over to the Halifax. Once again, the consensus was confounded. They're really not very good, the economists, at predicting the Halifax house price index. But in month to month, there is significant variance. Consensus said 0.1. I did a LinkedIn poll in a timely fashion, as I usually do. That said similar. That sort of said flat, really, pretty much. But instead, the index was forward 0.6%. What did the headlines hit? What did they take out of this? Highest house prices of all time, because it was Halifax's highest print ever. Nationwide actually isn't there yet. But of course, they just, this is agenda and clickbait and headline grabbing for things that are just not true. What the media does, unfortunately, what the mainstream media does. September was a minus 0.3% print, but again, that would have been in line with that walk-in analysis. If you see, said the sole subject to contract prices in October, which won't be the only driver for the Halifax, and they'll be relying on their own HBOS mortgage lending data, of course, but they were up 1%, weren't they? We said that earlier. It was quite a big jump. Halifax were up 0.6. In September, they were down about 0.7, and Halifax was down 0.3. So Chris Watkins' figures seem to be a lot more accurate in being able to predict what the Halifax house price index is going to say. And I'll actually try and keep an eye on that going forward, just out of interest. So annually they're at plus 1.9%, and as I said, that's my range for the year now, 1.5 to 2. I've been saying that for some months. Halifax mentioned resilient demand, mortgage approvals at their highest level this year. Well, it's very tight month to month with mortgage approvals. 65,000-ish. It's like 1,500, 1,800 mortgage approvals between the range over the last number of months. So, and things have settled down since the reintroduction of the 125,000 stamp duty band in England. Northern Ireland cracked on, up 8% year on year. The Halifax tell us slight falls in London, minus 0.3 on Halifax now. So Nationwide not the only ones printing a negative number for London for the year, and the South East at minus 0.1. In England, the North East is prevailing at plus 4.1, but Scotland got its nose in front of the North East by posting a plus 4.4%. So there was that record high. What is that record high? Well, Halifax's number is higher than, quite a lot higher than Nationwide's and the ONS's average house price number, 299,862. So imagine the headlines when we hit that 300,000, which there must be half a chance of us hitting in November, although market tends to get quite competitive around Christmas, so maybe it will go backwards again. We'll know in a couple of weeks' time. Usual stuff from their report, usual caveats around affordability, slowly improving, but surprisingly good data for the bears this month, who largely, of course, pretty much ignored it because it didn't suit their arguments. What about the weekly publication from the ONS that I look at on occasion, Economic and Social Change Indicators? Well, it looks back over recent weeks and months, and one interesting stat was electric cars represented more than 50% of new car registrations in September 2025. And perhaps that single stat on its own might be why it's time, according to the rumours and leaks for the Treasury, to stop incentivising EVs, either by introducing this 3% a mile tax that's been talked about, or ensuring EVs pay congestion charge, although that's generally done at a more devolved local level. I'm talking about central London there, they're talking about doing that, or a combination of other things. But that sort of level of penetration, though, withdrawing subsidy makes perfect sense. Changing the shape of the tax system is a different conversation, though. Now, if you know anything about tax on fuel, vehicle excise duty, it's the biggest con in the world because it's been frozen since 2010, and it's always been taken into account that in the Office for Budget Responsibility the government say they're going to reintroduce it, so we'll include it in our figures, and it's never not reintroduced, but the rise be reintroduced. Hasn't happened, and no one wants to be that unpopular, although I'm not sure this Labour government have put too much thought into what would make them popular and unpopular from a policy perspective, and if they have, they need to fire their advisors, quite frankly. There's definitely nothing special about them, or maybe there's everything special about their special advisors, I don't know. So 54%, 12 months ago, the penetration was 44%. Now that 54% is full battery electric, PHEVs, hybrid styles as well, plug-in hybrids, etc. Battery alone was 23% of the total. But if you went back to January 2020, the percentages in terms of car sales were 25.5% diesel, 62.3% petrol, 12.2% electric. In September 2025, we were 4.3% diesel, 41.7% petrol, 54% EV, as it said. So still plenty of new petrol being demanded, as you can see. So the scale of the JLR cyber attack became clear. It wasn't responsible alone for this, but 24% fewer vehicles were produced in September 25 than August 25. So a huge difference. UK retail footfall was down 8% compared to the equivalent week the year before, although let's not compare too many things week on week. Retail footfall is still about 6% higher than it was in the middle of last year. System prices of gas and electricity 26 and 28% cheaper, respectively, than they were in 2024. And yet the bills are still up. Isn't that interesting? The average direct debit transaction is still only 7% higher than it was at the beginning of 2023. Much more inflation than that in the interim, but people have switched to cheaper alternatives or participated in more smaller transactions. In the same period, debit card spending is up 13% or so. The other data contained in this report shows redundancy stabilising after a reasonable peak since 2023. Far fewer online job adverts, as we know. An increase in new VAT reporters, so companies registering for VAT, 9.5% since the beginning of 2023. That's a month-on-month number, to be clear, not just 9.5% of companies registering since the beginning of 23. Automotive fuel 8% cheaper than the 1st of January 23. And renter affordability at 29.7%. High historically, but on average underneath the 30% threshold that the ONS sets. Now the industry sets a 33.3% threshold as a minimum that I've ever seen. Some use 40%. And London uses 50% as its high watermark. Now, are you feeling guilty for not paying enough attention to the bond markets? That's the best gag I've got, so it doesn't get any better than that, folks. But have no fear. The 5-year had an up week in terms of yields, opening at 3.888 and closing at 3.933. 4.5 basis points up or so. Very casual drift upwards. They tested 3.95 Friday afternoon. It wasn't really immediately obvious why that happened, but it was very thin margins, realistically. So I'm not going to worry about that too much. Thursday closed around the 3.9 handle, and it was equivalent to a swap market close of 3.574 on the 5-year. That stacks up pretty well. 1 month ago, it was 3.795. 1 year ago, it was 4.01. And of course, 1 year ago, it was a week and a bit after the 2024 budget. What about the 30 years? Well, they followed a similar pattern. Open at 5.181. Looks like a much more sensible rate. I still think it looks like good value for fixed income investors. And closed at 5.252. So a 7 basis point rise. So the yield curve got steeper last week. My range for the 5-year is still 3.75 to 4.25. It's been my viewpoint around 18 months now, which actually sees the swap, with the discounts we've been seeing, 3.45 to 3.95. That's the sort of range I'm looking at. Add a couple of percent onto that, and that explains your mortgage rates up between sort of 5.4 and 5.9, which is roughly what you're seeing, unless there's anything particularly special where you need, something alternative, something niche, something from a premium lender. Of course, you're going to pay more, right? You always do. So we spent, a decent amount of time in that range over the past 12 months. We still spent some time outside of that range on the gilts. I'm not a bond trader, remember, but I try and set these kind of parameters that I try not to shift too often, because in property things are slow. We don't necessarily know where we're at. We want to try and know where we're at. That's the whole point, right? So The 3-year UK gilt is actually at 3.649 and the 1 year at 3.623. So that's a huge gap down from the yield curve 12 months ago. The 2-year looks a little bit more anomalous, but the steepness really starts at 3 years. And so the 5 years are that bit chunkier and lumpier. The overnight index swap curves predict a bank rate of 3.43 in 12 months' time. I'm still predicting above this. I still think we're going to struggle when we finally get below 4%. We've already struggled to break that 4%. I always said we would struggle to break 4%. That has been evidenced by the hold at the recent Bank of England meeting, although it was only just a hold, right? So let's just segue into that deep dive and the decision to hold the rates at the Monetary Policy Committee meeting that took place last Thursday. So the pattern interrupt was that for the last 5 meetings before this one, that had been accompanied by a revised forecast. So they do a revised economic forecast once a quarter. So at the last 5 times they've done that, they cut the interest rate. August 24, November 24, Feb 25, May 25, August 25. 5.25, down to 4%, 0.25% each time. Quick review of the schools of thought, right? The rate being above the natural rate. Now, the smart people think the natural rate is 3.5%. I've argued it's more like 4%. Keeps a lid on the economy. It makes it harder to grow. Capital is more expensive than it would otherwise be. In the ideal world, you could be around the natural rate because the economy is functioning properly and you're not reeling from shocks. As I said, the most recent one, realistically, being the increase in employers' national insurance. How's that manifested itself? Unemployment. What are the second-order consequences of unemployment? They are significant. What are the cost of replacing the 300,000 jobs that have been blown off? Really very significant, tens of billions, as much as you raised in the first place. So fantastic job there, Rachel. But of course, that money's raised every year, whereas that's a one-off. So arguably still economically worth it. But this is what happens at the top level. You're pushing numbers around on spreadsheets. There are no free lunches that you can suddenly access new money. Although there are a few ways you could access new money, which I think I'll spend some time talking about on another video, because I've got off on quite a tangent there if we wanted to. Now, you need to be below that natural rate if there are economic issues that need intervention and attention. Now, arguably, there aren't those issues at the moment. There are self-inflicted issues like employers' NI, but, the PMIs are doing okay, apart from construction. We don't need macro intervention for that. Actually, I've been tipped off Help to Buy is coming back at the next budget, so I thought I'd share that with you guys on the video today. New build units only. Yes, there'll be a new name, Buy to Help. Help me buy, help people buy, whatever the hell it'll be. Let's see how good my source is, because I'm now on the record as sharing that one with everyone. But the overall expectation throughout this year was a cut in November. That's what everyone was telling me was going to happen. I said there'd only be 2 cuts in 2025, because I didn't think we could handle more than that. We've obviously already had 3, so I've been wrong. And rates are not going up at December's meeting. You can pretty much bet the farm on that. So I'm already 0.25% out. And I might end up 0.5% out as well. Let's see. The consensus still says there will be a cut in December. Now, that only makes sense based on the timing of the budget, but the bank won't have this new forecast. Let's see what happens. They will be operating, I think, on the basis of how inflationary or not this budget is deemed to be. So we're going to go off on a little segue down the inflation pathway here. I'm going to do this because I haven't seen anybody else try and do this anywhere. And I can understand the educated opinion. This is about how good or bad the budget is. But I think that's probably unnecessarily partisan, to be honest. Who gets hit, which, as discussed above, is going to be the people for this one for sure, is not really our concern. How inflationary or disinflationary will it be? That is much more interesting when we consider the near-term future path of the interest rate. So what do we know? Well, we need between 20 and 50 billion in terms of a hole to plug, mostly based on what will be a revision downwards in productivity and growth figures coming from that compared to what the OBR was predicting before, although the growth this year has held up better than many commentators predicted, including me. I said 0.75 to 1%. It looks like we'll end the year closer to 1.5%. Those are the sort of ones I'm delighted to be wrong on. Really good result, but I found it difficult to predict apart from anything else because I didn't really have full visibility of how much better or not, or what, or not even better, but bigger the public sector would be, thanks to the amount of money being pumped into it. And also the amount of consumption would be well off because so much more money got pumped into paying public sector workers who are a little bit more poorly paid as a general rule than private sector workers. So they tend to consume even more of their marginal pay increases. So what are people predicting for the budget? What are they talking about? Well, one of them is the proposed restructure to VAT, levying VAT threshold at 30 grand rather than 90 grand turnover. That would be hugely inflationary if they did that on its own. You're looking at adding between 0.7 and 1% to CPI. Those numbers are not really in dispute. That'd hurt a lot. And there's no real way this can be on the agenda at this time, in my opinion. That 30k threshold actually might make quite a bit of sense in the medium term. It looks a lot like a lot of other Western economies, that's for sure, but it ain't going to see rates coming down anytime soon. And you're not going to want to put any more inflationary pressure on the fire at this stage, unless you're really quite stupid and don't understand macroeconomics. Still, on the other hand, taxing people on income and hitting them in the pocket is actively disinflationary. It makes inflation lower, takes money out of their pockets so they can't spend it. It makes macro sense, but it's not a very good sell, really, especially if we remember the manifesto commitment, which of course has technically been broken already, being not to raise tax on working people. Because they said they weren't going to touch national insurance, of course, and they touched it very, very much in the budget last year, as I've mentioned 16 times today already. But the rumour that's now gained traction there is 2p going on income tax and 2p being cut from employee national insurance. From a fairness perspective, you should get rid of the whole of employees' national insurance. It should all go on income tax. Yes, this hurts landlords. Sorry, folks who've got assets in their personal name. Still 94% of rental properties, unbelievably, are in personal name. It also hurts pensioners. But on the flip side, it gets pensioners with larger incomes, such as those sitting on utterly unsustainable final salary pensions, which still hasn't been addressed adequately in the public sector, to pay as much as they would if they were still employed. And surely they should be paying the equivalent tax that they should if they were still employed. Goodness me, it surely must be inherently fair. But it's symptomatic of this government to tweak rather than do something bold, proper, radical, whatever. The one cast iron guarantee is to extend the fiscal drag period out to 2030 from 2028, freezing those income tax thresholds even further. This is going to be deemed to raise about 10 billion or so, and it's such an easy win since tax doesn't go up, inflation does the work, right? The rest of the taxes mentioned won't raise a huge amount and will be more political than anything. Tweak inheritance tax threshold, getting the threshold down from 100 to 100,000 before inheritance tax applies, down from the 325 plus 175 on your personal home. Make the potentially exempt transfer period for gifting 10 years or 12 years maybe, rather than 7. Tweaking CGT and the likes. I've seen the figure batted around this morning before I came on the live, actually, at £12,000 ISA limits, for example, rather than 20. Addressing pension relief could be helpful. If they fixed the rate of relief at 25 or 28%, it would be inherently fair. Or even they could go to 30% and use it as a little bit of redistribution. But you don't need to try and redistribute at every stage. You just need to try and avoid regressive taxes. One of the reasons why council tax is so bad. And of course, the council tax on the higher banded homes, which fair few posts about this. Dan Needle's a pretty good source for this sort of stuff. He notes that sort of 80% plus of the revenue would come from the band G homes, which is the well off still, but as always, tax has to be paid by a bulk of people, not 1, 2, 3 or 4 people, because they will change their behaviour much more easily apart from anything else. And it's VAT that raises so much money because everyone pays it. It's income tax that raises so much money because everyone pays it, or certainly should do. Anyone who's working pays it, of course, I should say. Whereas VAT, anyone who's spending any money on anything that isn't VAT exempt pays it. But it would be inflationary to put it up. Right? That's why VAT is not going to go to 22% or whatever. So I like the lowering of the ISA allowance. I think it helps. People who are saving more than £5,000 or £12,000 as it might turn out in a cash ISA, they're not the people who are going to be reliant on the state when they get older, because they are preparing themselves properly for retirement. They have the spare money. They're making the effort to save it. But it's just an unnecessarily generous tax avoidance measure at their disposal. We need that money back in the economy. Savings ratio is too high, right? I know I make it sound like an easy game, don't I? But income tax increases are disinflationary. Put them in to help control inflation. That will get interest rates down and it will help to pay people back. Now, there's still a downside, of course, because it depresses demand by taking that money out of your pockets. And because of consumption being the biggest driver of growth in the UK, people consume less, growth is lower, tax revenue growth is lower, black holes which is a terrible phrase, by the way. I wonder how much Rachel regrets using it now. But these black holes pop up again and again as forecasts keep getting revised downwards. There's no free lunches, folks. You have to persuade the OBR this simply addresses a savings ratio which we as a country can't currently afford. In September, we saw the published Q2 savings ratio figures, 10.7%, which was up from quarter one's figure of 10.5. It was just down from quarter four 2024's figures of 12%. 5% would be sufficient realistically, and 7 to 8 would be a really nice steady state. I think 6 to 7 really would be fine. So in theory, if you can tease the money out of the pockets or disincentivize savings, there's a rope here to get a little bit of the best of both worlds. But still, 10 billion from a threshold squeeze, 6 billion from the 2 up, 2 down, they're calling it, which is not our usual sort of 2 up, 2 down fare, please note, but 2 on income tax, 2 off national insurance. That's 16 billion sorted. A billion or 2 from a council tax restructure on expensive property. Labour can ideologically get behind that. They can paint it as a wealth tax if they want, although that's stupid. Trying to tell people who are wealthy to stay out the UK or to get out the UK is fundamentally stupid. Cuts will be popular, and look, they're coming. Pat McFadden was shuffled into the DWP, Department of Work and Pensions, but won't change a lot on inflation and actually mean a reduction in demand because those on benefits tend to spend at least all of what they're given and any more that they can borrow as a general rule in economics. That's just the rules of the game. They have what we call a higher marginal propensity to consume. Yeah, as you become more creditworthy, you consume more, even more than you, as a rule, when you look at the data, right? So that could impact growth as it's measured, but not materially because the cuts of sort of 5 to 6 billion that have been suggested are not going to make a material dent in demand. So that's sort of high-level budget predictions as they stand today. I'm bound to do some more before we get to the date. We've got a few weeks left yet. Now, I'm trying to answer the question, are interest rates going to go down in December or not? That's what you're here for, right? Usually, the answer is it depends. But it likely depends more on what revisions downwards there are going to be on these growth predictions on the basis the Treasury will be sensible about how the budget will affect the interest rate in the medium term. That's what I'm hoping for. And I know the Treasury sets fiscal policy, its tax policy, its revenue base. They don't set monetary policy. It's done by the Bank of England. But don't think that they want higher interest rates than they otherwise need. If they do, and they're not trying to work that into the system, working in concert with the Bank of England, that's fundamentally stupid. And that's effectively what Liz Truss and Kwasi Kwarteng did. Ignore the Bank of England, it's a quango, blah, blah, blah. Ridiculous conspiracy theory, realistically. I honestly hold the belief personally that I could get the long-term gilt yields down by 1% or so fairly easily if I was in charge of number 11 Downing Street. And if I had a mandate to strongly influence the Bank of England, simply addressing the way quantitative tightening has been done, as I've spoken and written about before, alongside giving the bond markets more long-term confidence in the future of the UK. I could be talking absolute biscuits here, right? Could be nonsense, could be immaterial. I'm not standing anytime soon, folks, so don't panic. This isn't the party political broadcast for Adam's party or your party, my party, anybody else's party. If it's your party, you can cry if you want to. That's what I say. But my pragmatic nature would not be welcomed because ultimately everyone would bear a bit of the burden as I went on fixing the nation's finances. How about the actual monetary policy report from the people who matter, not me, and the meeting? Well, the vote was 5-4 to hold the rate. The 4 all wanted to cut by 0.25%. I predicted 6-3. I wasn't a million miles off. I was only 1 vote out, but ultimately I didn't get it right. It does show how everything's finally in the balance at the moment, though. A vote either way could argue if it had been deemed fair enough. But I think the best conclusion for the country at this time was come to by the Monetary Policy Committee on this one. But then I still think they should hold the rate in December and then maybe cut in Feb, depending on what's happened to inflation, depending on what we're seeing. What does the committee think? Because remember, they have to predict forward. If they cut the rates today, they always say the same thing, 6 to 18 months to make a difference. So we're looking at inflation in 6 to 18 months' time. We're not looking at inflation in the now. even though the press try and drive the conversation towards what's going on now, like they always do, which is annoying. Luckily, the Bank of England Committee don't really care. They're paid not to care. They don't have to go on TV and answer loads of questions. They only speak in very controlled environments. That's the right way for it to be, because every single dot, comma, and everything else is analysed with major league scrutiny and impacts markets that have, serious depths of liquidity that we need to be cautious about, because we don't want to be paying more for our debt than we otherwise need to, right? They think inflation's peaked. You remember we had that surprise print for September's numbers. People thought it was going to be 4% and it printed 3.8. It was a very nice miss on the downside. I think it's a little bit risky to say it's peaked, though, actually. I think they're probably right, but I wouldn't want to be betting a big sum of money on it, I'll tell you that. They see inflation at 3% early next year, which I still think is hopeful when you've got core at 3.5. And then in 2027, they see it back to 2%. And I think that's dreamland. I still think that's dreamland. If we went back 12 months, they was going to say that about 2026. They did say that about 2026, and it won't be happening in 2026, and they don't think it will be now. They talk of future cuts if disinflation progress continues. In honesty, we all know it's been slower than expected, and of course impacted by the inflationary nature of the last budget. As soon as that huge energy price spike worked its way through and dropped out the figures 12 months later, if you ignored that, it's been very, very slow. And core inflation, as I talked about month after month after month, it hasn't been below 3%, let alone going anywhere near 2%, right? But look, the bank's put its growth predictions up overall since the last policy report, and they still have 1.8% as the growth rate at the end of the forecast period. I do wonder how far the OBR will drift away from this in the November budget, but for what it's worth, I still believe we can achieve 2% or more in the UK when it comes to growth, but it needs some actually sensible policy and cutting of regulation, not just talking about it and going around going growth, blah, 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 doing some kind of rain dance or whatever it is. You've got to do it. You've got to cut the regulation that's stopping growth, apart from anything else. So they've got inflation at 2.5 by the end of 2026 at the bank. Possible but unlikely. I think I'd file that under. I'm more at the 3% sort of level for 12 months' time. That's kind of where the average business and consumer are, actually about 3%. And then conveniently, they're back to 2% by the end of 2027, but at 2.1 at the end of the forecast period. Now, that's another reason why not to cut rates last time out. They look at the 3-year forecast, and they want that number to be between 1.5% and 2.5%. Ideally, it would be under 2%, because that would tell them that they could cut more than the market thinks, and they might need to, because they might need to stimulate some demand. Because remember, we want some inflation, and I know we haven't had these conversations, although we did have them in 2020 and early 2021, about 0% rates and things like that, and deflation, which can be very damaging because people stop consuming because they're waiting for things to get cheaper. So, we're going to see a cut. Is it going to be December or February? And another one next year? That's what the markets think at the moment, with rates sort of setting at 3.5 or 3.25 if we were really lucky. You can tell I'm a little bit sceptical about that realistically, but you know where I am on these things. They still see unemployment of 5% by the end of this year, but the better noises in the PMIs mean this might be a little bit too bearish these days, but we still need to see the budget. Let's see another quarter of PMIs. Let's see what the minimum wage looks like. They have 5% being the new normal for unemployment, dropping to 4.7 in 3 years' time. So whatever economic model they're using, they're not expecting this government to spend a lot of money or be particularly successful in creating jobs. And they see the economy as having this increased spare capacity at the moment, excess supply, the macroeconomists call it. And I could get on board with that. Disinflationary, but also inefficient. And then this will work itself out, the economy, by the end of the forecast period, which is very convenient and very hopeful, I think, to be honest. But their projection for the bank rate is it bottoming at 3.5 next year and staying there or thereabouts before potentially moving upwards in 2028. Now, that would be a heating up economy that would need a bit of cooling. It's had plenty of cooling since 2022. We know that much after the V-shaped recovery on the COVID side of things. Now, inflation is all the fault of labour costs, according to the bank, Rachel, and food price inflation, which isn't just about the cost of delivery, although the wage rises there haven't helped either. That's what the bank is saying to an extent, and also that's what the ONS kind of agree with really as well. Average annual private sector wage growth, ignoring the public sector, which isn't the macro correct way to do it, of course, is down to 4.4% in the 3 months to August. So that's where we are. Below the triple lock, I note. Short-term household inflation expectations remain around 4%, which isn't far off, and also becomes a self-fulfilling prophecy. The bank have Q3 growth around 0.1, Q4 at 0.2. Neither of those sound too far off to me at this rate. They've mostly already happened. I mean, we're more 30% into Q4, so you'd expect those forecasts to be good, although it doesn't always work like that, right? But getting the savings rate down, as I referred to before, would also be helped by cutting rates, of course, because if you lower the rates, there's less incentive to save other than anything else. The bank always look quite closely at the VU level, the vacancies divided by the number of unemployed, and it's further below its estimated equilibrium level. So they're saying too many unemployed, not enough vacancies. It's the ratio between those two. But remember, vacancies have fallen 39 months on the spin, and unemployment has rocketed since that 2024 budget. Bank looks at margin in firms as well, and ultimately margins are lower than Q4 2019. Now, I've written a few times over the years about how Labour tends to win, small L Labour, as in people, as in workers, tends to win the arm wrestle over capital in the years that follow a pandemic, right? 30, 40 years these sorts of effects last for, or historically have lasted for. But enhanced inflation, which is the other guarantee of a post-pandemic period, still takes more money out of people's pockets, so they don't feel the benefit of winning that arm wrestle. There's also much more of my sort of chat in the report, which is hidden in their boxes B and C. Elevated inflation expectations could cause inflation to remain persistently high. Hello, folks, that's already been happening, it's already happened, and it simply won't not continue. Transitory, my bottom. They speak of structural labour market changes, which are symptomatic of a post-pandemic period. Lower participation rates, multiple reasons, one of them, in my opinion, being an overly generous welfare system, if you're willing to work it to your own needs. And that's one factor, right? I just want to pause there and put a little bit more effort in than the bank did, to be honest, and also say what the bank can't. Here's where we are. Inflation-linked benefits are up 3.8% next year. Tax thresholds are frozen. Active fiscal drag already until at least 2028, probably till 2030, when we see the budget. Benefits are not income. They're not taxed at an income tax rate. So as the minimum wage continues to rise, it's now halfway, basically, to the higher rate tax threshold. Marginal increases in income lose 28% to PAYE, which is currently split 20% to income tax and 8% to employee NI at the moment. And to keep these numbers easily processable, a full-timer on minimum wage with no other income gets 50% of their income without tax, thanks to the personal allowance and the employee national insurance allowance thresholds, and it gets the other 50% at a marginal rate of 28%, and therefore they pay about 14% income tax in total, right? Add 4% for next year's rise, likely larger than 4%, as I said earlier. It's another £1,000 a year or so. You see 720 quid of every £1,000 when you're at that level of income. So your income goes from 25k gross, 21.5 net, to 26k gross, 22.2k net. If you get 4% more on benefits and you were at the benefits cap already, £22,020, that would mean you'd need to have at least one child, in fairness, then 4% on that is an extra £900 a year rather than 720 quid. Right, so 20% more. Now that little bit of mathematical gymnastics is just to show you and make you think about the fact that averages have changed and incentives have changed slowly in the wrong direction since inflation has been high. On average, benefits claimants are 25% better off after tax simply because of inflation versus a working person on minimum wage. That's the marginal difference I'm talking about, right? Now, a great man, Charlie Munger, once said, show me the incentive and I'll show you the outcome. He was a wise, wise man. Why do you think our figures are so far out of kilter since the pandemic compared to all of the other Western economies? Higher levels of sickness, higher levels of claiming generous allowances, 1 million people claiming all 4 levels of personal independence payment. The government do get this. They just need to persuade their own party, I know, right, to have the difficult conversation and do the right thing. Now, this soapbox, perfectly justified in my view, is where I'm going to finish for this week. Slow change, just as inflation brings about, is some of the hardest for the government to change, to bring about, because there's no trigger event. There's also a limited number of people who sympathise with and understand this argument enough inside the Labour Party, in my view, but that's a more political bent. Now, as I draw this week to a close, the next property business workshop is prepared and we turn our eyes to 2026. That next slot is online and available. We start the year with a bang, discussing strategic planning and how to make the most of the next 12 months, with some of our own methods and takes on productivity and time management, alongside systems and processes. The other half of the workshop is about the most common pain point in SME property businesses: accounts, bookkeeping, and group accounting. This is about measuring asset performance. It's not about how to use Xero, but it's about how to make the most out of financial information. What should you be seeing monthly? How should you interpret it properly and use it strategically to grow your business safely but quickly? Super early bird tickets are available. You get a genuine 20+% discount off the face value. And as always, we've got real life case studies about our own experiences. We close with our no holds barred Q&A. Have you got anything individual to consider? Well, get yourselves a VIP ticket and join us for dinner in a smaller setting with an opportunity to discuss any specific roadblocks or issues in your property businesses at the moment. That's the best way to get a substantial conversation with myself, Rod, and other experienced property business people. Join us Thursday, 22nd of January 2026, Central London. And the link is in the show notes and also is at tinyurl.com/PBWNINE. But above all, please remember to keep calm. Always listen to the supplement and carry on. There's going to be opportunities abound this year, the coming year, 2026, towards 2030 and beyond. They've set a landscape here for a surefire bull run. And if Help to Buy is coming back, it's going to push new build prices up. And there's a ripple effect in the whole of the marketplace, which benefits the secondary market, benefits everybody. It will be slowish. It will take a little while longer to get off the ground, but I don't mind that because it makes it a little bit easier for us to see what's potentially going to be happening, talk about it, analyze it, and ultimately, of course, most importantly, do something different about it, do something different with our business strategy, right? The amount of stock is still around, is still keeping things suppressed at the moment. But as the market continues to improve slowly, I still think it's a case of here we go. Thank you to everyone for tuning in.